The program examines the causes, transmission mechanisms, and lessons of the global financial crisis of 2007 to 2009. The crisis emerged after a prolonged period of low interest rates, easy credit conditions, and rapid growth in housing prices, particularly within the United States. Financial institutions increasingly expanded mortgage lending to high-risk borrowers, including subprime borrowers with weak credit quality. These mortgages were then pooled into structured products such as mortgage-backed securities and collateralized debt obligations. The program emphasizes that excessive leverage, weak underwriting standards, and overconfidence in financial engineering contributed significantly to the buildup of systemic vulnerabilities across global financial markets and banking institutions. A major contributor to the crisis was the originate-to-distribute banking model, where lenders originated loans and then sold them to investors through securitization structures. Because banks no longer retained most of the credit risk, underwriting standards deteriorated substantially. Mortgage brokers focused on loan volume rather than borrower quality, often encouraging unsuitable lending practices to generate higher fees and commissions. Structured products containing risky mortgages received unrealistically high credit ratings from rating agencies, especially senior tranches of collateralized debt obligations. The program explains that these products became highly complex and opaque, making valuation extremely difficult during periods of market stress. Investors therefore underestimated the true risks embedded within the financial system. The crisis intensified because many institutions relied heavily on short-term funding sources such as repurchase agreements and asset-backed commercial paper to finance long-term or illiquid assets. This created severe funding liquidity risk because banks depended on continuous market confidence to refinance their obligations. As housing prices declined and mortgage defaults increased, lenders and investors lost confidence in structured products and the institutions holding them. Short-term funding markets froze as counterparties refused to roll over financing arrangements. The program highlights that this asset-liability maturity mismatch became a major source of systemic risk, contributing to the collapse or near failure of several major financial institutions, including Lehman Brothers and other globally significant banks. The program also examines the role of central banks and governments in responding to the crisis. To prevent complete financial system collapse, central banks worldwide implemented aggressive liquidity support measures and reduced interest rates significantly. In the United States, the Federal Reserve expanded access to the discount window, introduced the term auction facility, and created lending programs for primary dealers and financial institutions. Governments also intervened through initiatives such as the Troubled Asset Relief Program and the bailout of Fannie Mae and Freddie Mac. These actions aimed to restore market confidence, stabilize financial institutions, and support economic activity. However, they also resulted in substantial expansions of central bank balance sheets and public sector intervention. Topic concludes by emphasizing the key lessons learned from the global financial crisis. The program stresses the importance of prudent liquidity management, robust underwriting standards, transparent securitization practices, effective governance, and comprehensive risk oversight. Institutions must recognize that excessive leverage and over-reliance on short-term funding can create systemic vulnerabilities even when firms appear well capitalized. Regulators have since introduced stronger capital requirements, stress testing frameworks, and liquidity standards to improve financial system resilience. The crisis also demonstrated the limitations of relying solely on quantitative models and credit ratings without understanding underlying economic risks. Ultimately, the global financial crisis remains one of the most important case studies in modern risk management and financial regulation.